Let's get to assets disposals. We will be calculating depreciation, and it will be depreciation of new assets and the assets that we got rid of. I will start by explaining the definitions first. Now, sale of fixed or assets disposal. I will first explain what an asset is. An asset is a resource that we are using and we control that resource, and that resource is what we purchase, and we're going to use it to make money, which is in accounting, they normally refer to it as economic benefits, which can be cash and its equivalent. Now, for grade 12, please note that assets are always recorded at cost, which is the historical cost plus cost incurred in bringing the assets into conditions ready for it to be used. The asset will increase and decrease at cost price. Now, I want you to highlight that, all right, because it's very, very important. The asset will increase at cost price plus any directly attributable cost when it is purchased and decrease at historical cost when it is sold. Now we have what we call an asset register, which is simply a record of the assets movement, specific assets movement, all right? All the assets of the entity are recorded in the assets register. All the movements relating to the assets will be recorded in this book. Movements with respect to additions, depreciation, disposals for each of the entity's assets will be recorded in the asset register. Now, what is this economic life? Economic useful life is the period over which you expect to use the assets in order to generate money. And the economic life is determined by the period over which the assets expects, and the entity expects the assets generate inflows of economic benefits. Note that depreciation rate is determined based on the useful life of the asset. It is important to make sure of the following facts regarding fixed asset before the sale of fixed asset, all right? Assets are recorded at the historical cost, that is the cost price. The accumulated depreciation, I've highlighted important things for you there, is the total of all depreciation written off on a specific asset based on the asset's useful life or any depreciation method considered to be appropriate for that specific asset. It is regarded as a valuation allowance for an asset. As a result, it affects the asset negatively. Hence, it has a negative or credit balance in the statement of financial position, i.e., the balance sheet. Depreciation decreases future economic benefits expected from using or selling the assets. Therefore, accumulated depreciation is accumulated decreases of the asset's future economic benefits or asset as the future economic benefits relate to the asset. I need you to understand that depreciation is when you take part of the asset and you convert it into an expense. The part that you're converting into an expense is part of the asset that you've already used to generate money. The book value of an asset is the asset cost price less its accumulated depreciation. Another name for book value is carrying value. Now, when we do calculations, pay attention to the following. Depreciation can be on diminishing balance or reducing balance or carrying value or book value. So all of those mean one and the same thing. It means that depreciation will be calculated on the carrying value, and depreciation will actually be calculated up to the date the asset is sold. From when it was purchased up to the date it is sold. When we calculate carrying value, it will be cost minus accumulated depreciation. Note that accumulated depreciation is the sum of all depreciation of the asset from when it was purchased until the date of sale. Now, when we depreciate at cost, which is the second method, later on we will learn about the third method, which we call depreciation based on production number of units produced, okay, production units, which will be new for the IEB syllabus, all right? Actually, these guys are very, very lucky because I actually did that when I was doing my second year, if I'm not mistaken. Yeah. All right. Now, depreciation on cost is depreciation will be calculated at cost price, which is just your cost price multiplied by your depreciation rate. And let's see what this is all about. Here we need to calculate what we call the assets register. I will give you certain information. The purchase date will be the 1st of January 2017. It is depreciated on cost price. Depreciation rate is 20% per annum, and the cost price of this asset is 650,000. How do we calculate depreciation on this asset? For the First, note that depreciation is calculated at the end of the financial year. And that's what you need to take notice of, right? Now, here, please note that the end of the financial year will always be given to. But for this one year, it was not given to you, and I'm going to give it to you now, which is December. So for the first year, the asset will be depreciated on the 31st of December 2017. The reason why we depreciate at the end of the financial year is because we need to figure out for this year, how long did we use the asset? All right. The cost price of this asset was 650. So when you calculate depreciation, you will just take the cost price multiplied by the depreciation rate, multiplied by the months over which you use the asset, divided by the total number of months. Now, the fact that they said is 20% per annum, it means that this asset was used, will be calculated, depreciation will be per annum, which is for the entire financial year. That's why we are dividing by 12. Now, 650 times 20% times 12 over 12, that will give you 130,000. In the first year, your depreciation, your current depreciation and accumulated depreciation will be the same. When you calculate carrying value will be the cost price minus accumulated depreciation, which is in this case 650 minus 130. That will give you 520. In the next financial year, because they say depreciation is on cost price, you still take the same value, which is 650, times it by 20% and times it by 12 over 12. That is because for 2018 financial year, we used it from the 1st of January 2018 up to the 31st of December 2018. So that is 12 months. Depreciation for the second year will be 130,000. You will notice under cost price method, depreciation every year will be the same unless the asset was not used for the entire year. All right. Now, question is, what if your asset is idle and you're not using it? You still depreciate, right? Because your intention is to use that asset. Okay. Unless obviously you identify it as held for sale. We'll learn about that when you get to second year, third year. Yeah, second year, I think. Now, accumulated depreciation will increase to 260,000 rand, which is last year's accumulated depreciation plus this year's depreciation. It's 130 plus 130, it gives you 260. To get the carrying value, nothing has changed. It's always cost price minus accumulated depreciation for that financial year. The cost price is 650. I'm going to take that 650 and subtract this 260,000 to get the carrying value on the 31st of December 2018, and that will be 390,000. Depreciation for 2019 financial year will still be the same because we are going to use it from the 1st of January 2019 to the 31st of December 2019. So we used that for the entire financial year. Take 650 times 20% times 12 over 12 because we use it for the entire year, and that will be the again 130. Now 260 plus 130, this 260, you add it with 130, it'll give you 390. Now your new carrying value will be 650 minus 390, and that will be 260,000. Okay. Another method is just to take 390 minus 130. It will still give you the carrying value of 260,000, which is carrying value minus current year depreciation. Last year's carrying value minus current year depreciation will give you this year's carrying value. Okay. And I repeated the same thing for 2020. However, for 2021, there's a little bit of complication there because if I recognize my depreciation, I'll end up having accumulated depreciation of 650, meaning that my carrying value will be 0. Please note that carrying value of an asset, especially in accounting, cannot be zero, because even if that asset has actually reached its end of useful life, it still generates some value for the business. Like there are cars that you see on the road, you can tell that this car reached its useful life long time ago, but it's still doing the job, which is taking a person from one point to the other, or delivering goods, or delivering trash, or it can be a truck. All of those will be generating cash. And that's why the scrap value of an asset that has reached its useful life must always be what? It cannot be equal to zero. So I can't do this. So I'll have to recalculate this. So you will need to limit your carrying value or your depreciation to last year's carrying value minus one. So basically, the carrying value you had at the beginning of the year, you just take it to minus one and you limit your depreciation to that value. So I'm going to take my current year depreciation, which is 130,000, and scrap it. And I'm going to look at last year's carrying value. And last year's carrying value was 130,000. I'm going to take that 130,000 minus one, and it'll give me depreciation. 130,000 minus one will be 129,999. That's why I'm going to limit my depreciation to. That's what I'm going to limit my depreciation to. Okay, which will result in me having a carrying value of 649,999, and the value of this asset will just be one. And I will stop depreciating from there because I can't depreciate. Okay. Even if I depreciate, I'll have to limit my depreciation to last year's carrying value minus one, which will give me zero. So there's no value left here. All right. That's why I'm going to leave it at one. For as long as I'm using this asset, it means that I can't depreciate it anymore. Okay. And I think with taxes, well, SARS, you recognize this depreciation, and we call it wear and tear. So that will be deductible. If the SARS has not deducted the full amount, they'll keep on deducting it. But for you, you won't have a taxable depreciation. Okay. This is for those that are doing tax second year or first year. And I think it's second year, third year. Okay. And that's why we have what we call deferred tax. When you get to varsity, you will learn about that. Okay, let me move on to the next classwork. The next classwork I've got, the beginning, it was purchased on the 1st of January. It's the same as the previous one, except here, depreciation method is diminution balance, and the cost price is 230,000. So how do I depreciate this? I use it for the entire year of 2017. So I will take 250 times 20%, and that will give me 50,000, which becomes my accumulated depreciation. Carrying value in the first year, in my first year, will be 200,000. When I calculate depreciation for 2018, please know that I can't use the cost price. Under diminution balance method, you use last year's carrying value. And the thing is, I'm explaining this using these tables right now. But when I get deep into it, when we get to asset disposals, now people are asking me questions. Yeah, but why are we not using 250? Why are we using 200? Please note, we use last year's carrying value and we multiply it by your depreciation rate. That's why I took 200,000 times my depreciation rate, and that will give me 40,000 rand. Taking my accumulated, you see, I explained accumulated depreciation earlier on. What is accumulated depreciation? Is the sum of all depreciation of an asset from when it was purchased. All right. As long as we're using it, we keep on adding depreciation. It's a garbage bin where we put all our depreciation. Every part of an asset that we're expensing will be put into accumulated depreciation. And our accumulated depreciation in 2018 will increase to 90,000, which is 50,000 plus 40,000. And our carrying value will be lower, which will be 250,000 minus 90,000, and that'll give us 160,000. Okay, let's go to 2019. 2019, we will take last year's carrying value of 160, times it by 20%, and our depreciation for 2019 will be 32,000. Our accumulated depreciation will increase. It'll be 90,000 plus 32,000. That will give you 122,000. And our carrying value will be 250,000 minus 122,000, which will give us 128,000. For 2020, we take last year's carrying value, which is 128. I don't take 2018 carrying value. No, I'm taking last year's carrying value, which is 128,000. Take that 128,000 multiplied by 20%, and that will give you 25,600, increasing our accumulated depreciation from 122,000 to 147,600. Our carrying value will be 250,000 minus 147,600. That will give us 102,400. Last time, or our last part, will be on the 31st of December 2021. And we will take last year's carrying value of 102,400 and multiply it by 20% for the entire year. That's why you're multiplying it by 12 over 12. It'll give us 20,480. 147,600, which is last year's accumulated depreciation plus current year depreciation, will give us 168,080. Our carrying value will be cost price of 250,000 minus this 168,080. Our new carrying value for 2021 will be 81,980. I think I've explained that. Thank you for watching again. Try this classwork here. Just try the next classwork. Complete this assets register. When you're done with this one, please try classwork 2. I'll give you the purchase date here. Purchase date will be the 1st of November, 2018, and we are diminution using diminution balance method, 25 per annum. The cost price is 1.2 million. Pay attention to the end of the financial year, which will be the 28th or the 29th of February every year. Alrighty then. Enjoy the rest of your day. Thank you for watching. Please don't forget to subscribe, like, and comment. If you have any questions, please don't be afraid to email me.